My name is Max Borg, and I'm a partner with the Burns & Levinson Cannabis Business and Law Advisory Group. It's an honor to be here with you all today and to be moderating this panel with a distinguished group of pioneers and leaders in finance in today's cannabis industry. To introduce our panelists, to my left, we have Joe Campanelli, who is the president and CEO of Needham Bank. We have Travis Goad, the managing partner of Polaris Equity Group, a leading provider of commercial real estate loans for the cannabis sector.
Kick it off.
To his left, we have Sergey Sherman, managing director of Tuatara Capital, a leading venture capital firm in the cannabis industry. And we have Jim Kirsch, who is the chairman and senior managing director of Alliance Global Partners Canada, a leading investment bank in the industry and throughout. As you heard on a few of the panels to start today, capital, both in its structure and actually sourcing capital, is a very important issue that faces operators throughout the industry today. We're in very interesting times, and I wanted to start this panel. Jim, in today's capital environment, have you been noticing any recent changes or developments in the types of capital being raised and the structures that are being made available to companies?
Yeah, I would say that in the last 90 days or so, we've seen an influx of institutional investors from overseas, and our practice is all institutional, so we don't deal in retail. Because of the dynamic of the market and the pressure that's been on equities, we've seen that some of the existing investors who have been in the space for a few years have gone to the sidelines for a little bit so that they can redeploy their capital when things get a little bit firmer. But for those that haven't invested in the space now, they're really increasing the amount of work that they're doing to get up to speed. I think some of that is driven by potential changes in the regulatory regimes, which I know people have talked about for a long time, but we're at another one of those windows where investors are looking towards the midterm elections and also the lame duck session in hopes of things being liberalized somewhat to allow more institutions to play. So in our last conference, which we held about 2 weeks ago, we had a number of family offices and overseas institutional investors who participated, who are investing anywhere from $200 million to several billions of dollars, generally, who are now looking at the space, which we're encouraged by because we haven't seen that in a long time. In terms of structure, and I don't want to roll on too long, but it seems like we've gone from an equity world to a debt world, and now we're thinking more about equity again. Possibly because some of the companies are now fully levered up on debt or getting close to fully levered up on debt. And equity prices have been so depressed that there's a hope that equity will rehabilitate and there'll be a chance to have additional growth capital come through equity.
Right. Thanks. And Travis, there's been a lot of discussion about the debt that has been coming to the marketplace, and we heard your involvement in some of these transactions that have been discussed today. Can you first tell us a little bit about Polaris and what you do?
Yeah, so Polaris is the longest running commercial mortgage REIT in the cannabis sector. So we closed our first cannabis transaction in 2016. We've deployed, first we do senior secured loans on cannabis real estate assets. So you have to own your asset to qualify for our program. We have a mix of construction financing as well as a stabilized lending product for cash flowing companies. We'll typically lend up to 60 to 75% of the value or the cost of the real estate, including the build out for cannabis use. We've done about $500 million since inception. Today we have about $370 million in AUM. We are an open-ended evergreen fund and have been raising on average about $10 million a month in equity this year.
And I want to jump in a minute here to talk about the banking side of debt, but have you noticed any changes in the debt markets as we're seeing more lenders and more commercial lenders coming into the space?
I would touch on, there hasn't been a lot of changes, to be honest. Two of our kind of competitors had chosen to go public, and so when two of the people that are in the space that chose to go public, there's so much volatility. Most of them are trading below book value today. They can't even issue equity. We're actually one of the few people that have capital to deploy, and we're very active deploying it. Just closed a $45 million loan to TerraCent on Tuesday on their New Jersey and Maryland assets, and so we've actually seen our pipeline almost double over the last probably 2 months.
Right. That's exciting. Joe, can you talk about Needham Bank and your recent acquisition of Century and what the thinking was there in coming into the industry, as well as what the thinking behind the acquisition itself was?
Sure. We've been looking at this space for going on 3 years now. Spent a lot of time in Colorado, seen it there, the early entry into the space, over a decade of experience now, and really getting our arms around both the direct and indirect and sort of how do we play this out as an entity. And we're in the process of going de novo. And then we were fortunate to read about the Century Bank acquisition by Eastern and said, this can accelerate our transition by multiple years. And so it was a pretty easy process. We already done our homework on what we wanted to do, and we were lucky to pick up a great team that had been in it. They've had the regulatory experience to get the regulators somewhat comfortable in the transition of the business, so that would give us a leg up also. And we understand that we really want to go in as a full service approach, banking both the cash management side, which is in significant need of more protective cash management products and whatnot, along with the debt side, both to the companies and to employees.
And is the thinking that you're really becoming the leader here in Massachusetts, but is there a view to expand beyond Massachusetts?
Yes, and then when you look at the industry, especially Massachusetts, you're getting a growing population of multi-state operators, and really the MSOs will be the dominant consolidators as the industry matures. So it's important for us to bank the multiple tiers, from the single point to the multiple point statewide operators, all the way through the multi-states. So we're in the process of rolling out a national strategy.
Right. And from a banking perspective, I know you've been in commercial lending for quite a while. How is the underwriting process different, if at all, when you're talking about underwriting loans for cannabis companies versus other types of operators in your business model?
Yes, so that it probably is the most complex underwriting process I've ever seen in the industry. You have your traditional senior debt underwriting where you're looking at collateral coverage and all those things. You overlay with the regulatory issue, the fact that you're actually manufacturing product that's consumed. So you have to concern with product recalls and safety of the products being distributed. You have reputational risk. You've got a lot of uniqueness, and you have a regulatory environment in Washington that is evolving. It will get there, I believe, someday. But don't forget, the regulations now, especially on the cash management side, are really dictated by FinCEN. So once it is regulated, you'll have the regulators sort of revisit how they want to regulate the industry. So you kind of have to have a belt and suspenders on.
Right.
And we've invested heavily in technology and people and really thought through how the industry will evolve and feel that we can be a viable player, be a competitor nationally for an extended period of time, and building relationships. It goes back to, we bet on a jockey a lot. We want to understand who owns it, who operates it, who manages it, what their thought process is, those types of things.
And Sergey, can you tell us about Tuatara and the types of deals and what you've been doing in the industry?
Sure, and thanks for having me, Max. So Tuatara is a private equity venture capital firm that's focused on investing in the sector. It was founded in 2015. We've raised around $400 million across 2 different funds plus co-investment vehicles. We raised a $200 million SPAC on the NASDAQ, which we recently closed on a de-SPACing transaction. We generally invest across the whole cannabis value chain, but we primarily focus on selective state markets, typical limited license, and where we have good supply-demand dynamics. We like certain types of brands. I know we spoke a lot about brands this afternoon. We like ancillary plays, so we have investments in technology companies, marketing technology companies that are all focused on the space. And we've made some big bets in the biotech space, and the idea that some of the cannabinoids, especially the minor cannabinoids, are going to be coming synthetically from basically a test tube as opposed from a plant. And that's primarily going to be for the pharma channel and for the major ingredient companies. And that's generally how we think about the world. Primarily U.S. investors, although I would say over the last 18 months or so, I've been spending quite a bit of time looking at opportunities in Europe as well.
Right. And over the last year or so, how would you say things have changed, both on the public markets as well as on the private side, from a pricing perspective and a structuring perspective?
From a pricing perspective, obviously things have gotten more attractive towards investors, certainly over the last couple of months, given everything that has been going on in the sector. From a structuring perspective, most of our deals are heavily structured. We do support a lot of entrepreneurs and a lot of companies, but I would say we generally come in to the right place in the capital structure. We generally will not come into common equity. We generally come into preferred equity. A lot of times we'll come into a convertible debt to give us a little bit of downside protection. Unlike other venture capital firms, our positions are heavily concentrated. So once we pick a company and a team that we really like, we will back them with quite a bit of capital for them to be able to execute on their strategy. We're different. Other firms in the space, they'll put in $1 million to $2 million across 75 different names and get quarterly reports from the companies. We're much more hands-on, much more of a private equity style approach, because all of us generally come out of either traditional investment banking or private equity, and that's the way we generally approach the sector.
Right. And you touched earlier on some of the changes that we're seeing from the investor side, in that we're beginning to see more institutional investors, or at least looking at the industry, maybe not quite there yet, but can you talk about what you're seeing on the investor side in terms of capital coming to the industry?
Generally, yes, and I agree with Jim as well, that over the last number of months, we're starting to see more interest from institutional investors. Primarily, I would say institutional investors, I mean like large family offices that have the flexibility to invest in the space. And these are some of the largest family offices in the world that are actually doing their homework on the space, getting smarter. Some of them have made a few bets, primarily in the ancillary space. But you can see that this capital is sitting there. I think a lot of them are waiting to see what happens in Washington, with this election cycle and through the lame duck session. But certainly, I think people recognize that if you're not in the sector today and you're not sitting on losses, unrealized losses, this is actually a good time to invest, because you're able to find attractive companies that have very good growth prospects, and you're able to come in at a valuation and a structure that's a lot more investor friendly.
And so what are some of those conversations like in terms of, from a regulatory perspective? I think we're seeing certain hurdles that might need to be hit, whether it's descheduling, rescheduling, investors who are concerned about 280E. What are those conversations like?
Well, certainly, if you talk about descheduling or rescheduling, that will probably open up the whole investor universe. We all have opinions about what got announced a couple of last week with Biden's announcement and the potential for rescheduling kind of down the road. I think in the short term, people are looking really at this election and the lame duck session to see if something happens around SAFE, which is the banking bill, and whether or not that ultimately will open up some additional capital into the space. We'll see. I think eventually, if it passes, then yes, we do anticipate some additional capital, but it's probably going to be slower than people anticipate. In the end of the day, you still have to be able to do the underwriting. You still have to take the risk of investing in the space, apart from whether or not you can from a regulatory standpoint. But that's going to be the first hurdle everyone's focused on.
Right. And Jim, can you tell us about first what AGP has just been doing in the industry and what the role you've been playing is?
Sure. First of all, I want to say I completely agree with you. we're seeing the mirror image of the same thing, which is interesting because I'm investment banking and he's looking at it more like private equity. And I really admire your approach too. I think it's very healthy for the industry. Specifically to your question, so we've been super active in the space for many years. Last year we raised over $2.5 billion for cannabis as a lead or co-lead, primarily on exchanges, the CSE in Canada, and also in ancillary businesses on the NASDAQ and on the New York Stock Exchange for some Canadian companies. Some of the names that we've been a part of, we raised $125 million for Cresco. That was with 5 investors, so large institutional funds writing $25 million checks. That was done at a 3.3% discount to the market, no warrants. We were the U.S. lead for Curaleaf. We raised $230 million on their last raise. The largest investor there was 50 million Canadian, which at the time was 38 million US, which was a Swiss investor. We raised $400 million for the day trading darling Sundial, and a number of different cannabis companies. On the ancillary side, we raised a debt facility of $135 million for Agrify, a local company here. We also have done a number of financings for Akerna, which is a technology company, primarily equity. And so we've been active across the board in both debt and equity. But we were doing more. We were doing primarily equity, and then we were doing primarily debt, and now what we're feeling is more equity to come. And just reflecting back on some of the prior comments, I think all of us here today are in the business of providing capital for this growing sector. It's a sector in formation, and we're in somewhat uncharted waters in terms of. As Sergey said, not just the regulatory environment, but the business environment, right? Because the business is constantly changing. And when you have an industry that's largely shaped by government regulations that are forming constantly, both on the state, on the city, on municipal level, on the county level, on the state level, and on the federal level, everything's so dynamic, it's hard to really put a model in place and say, this is how we're going to treat it like it was cereal, right? Breakfast cereal. So it's a really interesting business to be in today, and whether you're a commercial lender who's providing capital, and by the way, we all provide capital at different costs, right? Yeah. So there's different layers of capital to put into the businesses and different times for different products at different prices, but they're all important, especially in a high growth industry like this is. And finally, what I'll say, and I don't want to offend anybody in the room, and it's not meant to be offensive, but when I first started investing in this sector, what I thought was this is an industry that is going from criminal to cowboy, from cowboy to entrepreneur, and from entrepreneur to serious business person. And we still have some of those hats being worn in multiple places even today. Right. But it is becoming more sophisticated, and what I think we're seeing is that whether you're big or small, you really have to have the same business principles and fundamentals that make any company successful. And you really have to be very cognizant of your capital structure and what your runway is, and controlling costs and expenses. And this is not an industry to get out over your skis on and be overly optimistic. I think 3 or 4 years ago, companies were raising billions of dollars and planting flags all over the world, state by state, country by country, and when it came time to build out those investments, there wasn't enough capital to do that, and those companies have since failed or restructured, and there's been others that have picked up the pieces. And then we're super active in M&A. We advised Cresco on the Columbia Care acquisition. We were also the advisor to Verano on the acquisition of Goodness that just got canceled. So we've been involved in, I guess I have to take the number down now, but we were at $3 billion the last 12 months in M&A, but we're at 2.5 billion. So until they close, I guess they're not actually closed, but that's for sure.
Right. And where do you see things going over the next 12 months in terms of on the M&A market? How do you see this environment potentially changing?
Well, I mean, I think that, and I have a disclaimer here, nobody follow this advice, ever. But I'll say it anyway. I mean, I think that we're going through a recessionary period. I think that Wall Street forecasts what Main Street's going to experience in the coming months. We've seen the capital markets be stressed since February. Much of that stress has come in the form of attacking risk-on stocks. And I don't know if anything's more risk-on than cannabis. So it's been a difficult period of time for cannabis equities globally. But if history foretells the future, what will happen is the Fed will raise rates for whatever, 1, 2, 3, whatever more cycles, and then they'll pause because they'll cause enough pain and the economy will say mercy, and hopefully we'll see inflation be tamed a little bit, and the overall macro environment should become better. And I'm just saying, you know, if we look back in time, we've seen this over and over and over and over, and I don't think this is systemic like 2008, 2009 was. I think the financial system's in relatively good health. We do have a number of outstanding issues that are unique, including global instability that we have in the war of the Ukraine and Russia, and that's certainly going to have its impact. But what we hope is that the economy is going to get to the point where interest rates will be stabilized, we'll enter a new normal, capital will start flowing back into the markets, and risk on will become very attractive. And when we see these recoveries in the macro market, traditionally in microcaps we see often a parabolic recovery. I mean, companies that have drifted down and drifted down and drifted down have been so far oversold, and there's so much short interest. When those shorts get broken, you could see them shoot up, and then all of a sudden, once they shoot up a tremendous amount, could be 20%, could be 200%, it attracts other investors who say, wow, look, this stock just went from 90 cents to $3, but it was at $20, maybe this is my entry point. So I'm actually very optimistic. I think that we're going to see some continued pain through the holiday season. I don't think the holiday is going to be a great economic season, and I think the Fed is going to pause, and I think that in the first quarter we'll start to get our footing, and second, third quarter should be growth again. But again, disclaimer.
And just to add to that, the markets are always ahead of the real economy. So what we're seeing, the volatility we're seeing in the markets right now, is pretty volatile, and the Fed's going to continue to raise rates. But I do believe that we will enter into a recession when the real economy catches up. But at the same time, the markets are going to recover a lot faster as we come out of that recession. So if I were to place a bet, I suspect the markets will start recovering once they know where the stability of interest rates is from a Federal Reserve standpoint, and then the rest of the economy will probably catch up a couple of quarters later, and as they start, as it starts to recover. But the other element here, just to Jim's point, is that for cannabis, I do believe that there's a disconnect between the stock prices and the intrinsic value of these companies, because some of these companies are growing fast, kind of doing the right things, and it's not reflected in the 20-cent stock price or whatever the stock price is. But eventually, that will come together.
And when you're looking at companies to potentially invest in, when you're looking for qualities, profitability is going to be the first thing that I would think you're looking at. But can you talk a little bit about what that underwriting process is for you on the equity side?
Yeah, I mean, I would love to find a profitable company to invest in.
Yeah, right.
But again, we're in a cycle where, especially in the private side, these companies are still very much in the growth phase. But what we're really looking for is founders who understand that it's important to manage capital, in a prudent way. This industry, we talk sometimes in comparison to other high growth industry, and biotech or technology comes to mind. When tech was 20 years ago, when it was growing very fast and it was unprofitable. People point to Amazon's been unprofitable for a long time. But one of the biggest distinctions is that these other sectors had access of capital, global pools of capital that were available, either private capital or a lot of them went public and had public capital available. Cannabis doesn't have that, so managing capital in a prudent way is very important. So when we're talking to new companies, we are looking at how much have you raised, what have you done, how have you invested, because at the end of the day, we're trying to find the people who are really backable, and then we'll change the business model is going to evolve anyway, but we really are trying to find entrepreneurs and people who have experience and are really backable, and we feel confident we can put our money behind them.
And I'd ask the same question to you, Travis, on the debt side. When you're looking at companies and identifying the qualities that make a company really investable, what are you seeing?
So a manager team is a very big part of that. Just like we backed Ed and team at State House, we think they're one of the best run companies in California. So we really look for competence of management team, but also quality of assets and what you have. I mean, we're at our core a real estate lender, but in this industry, you can't just be a real estate lender. You have to think about it as a political spectrum with pure corporate lending here, pure real estate lending here. Everybody is somewhere in between, but we're about as close as you can be to the pure real estate model while being properly collateralized. So we are still collateralized by the license and the OpCo as well as the PropCo, but we lend a percentage of the value of the asset, not a percentage of the value of the company. So in this situation, we view where we've been playing in the sector as more inside the risk spectrum, where some of these other business models, there's people out in the space that are much more towards the pure corporate model or a BDC model, and what we've seen is, that's just a little farther out the risk spectrum. The way we look at this sector is, yes, in established industries, those business models can thrive, but when you're in the very beginning stages of it's full of opportunity and challenges on the regulatory front, that there's just a lot of volatility. So we chose to kind of be in a more conservative space and have seen a lot of inflows and put out capital. So we heavily look at cost of what people have put into the facility, how they've built it out, how much skin they have in the game. We've seen more transactions than anybody. We've been doing this on the real estate side since 2016. So we know what an average producer should be able to do in a facility, what you can produce on a square foot, and we can make assumptions around that. I like to say if you're in the traditional real estate business and you lend on a CVS, you don't have to understand how the pharmacy business works to get comfortable with that. There's enough third-party data comps out there. There's Reese, there's CoStar, there's all these other data points that you can get to zero in. In a new industry like this, those data points don't really exist. And so you have to spend a tremendous time understanding the challenges these companies are facing, the opportunity set, and what's achievable and what's not. And to that end, because there isn't a lot of data available, we actually founded a separate data company. So we, Reese, CoStar, all your traditional real estate service providers don't cover the space. And so I have a hedge fund background. I saw the power of big data and what it can help you do to analyze markets and get comfortable with risk. So we have a best-in-class data team. We're scraping data from 20 different sources into a proprietary database, and it's helping us really get a view as to where these assets are, how many exist, how we can get kind of comfortable in lending in this sector.
And Joe, would love your thoughts as well on this.
Yeah, we're close to what Travis was talking about from a secured lender perspective. Yeah. We get some comfort. There's the quality of the people coming into the industry is very high. Successful entrepreneurs have been very successful in other businesses, can navigate the bumps in the road, because there's going to be some transition when you take an industry from infancy all the way through stability. But we're looking at all the other factors that go into it, from branding, from reputational risk. We're encouraged by the amount of capital coming in. You've got billions of dollars going into a multi-billion-dollar industry, so there's opportunity to provide senior debt there. We're selective in how we do it, just given the volatility in the marketplace, which will continue. But it's not for the faint of heart. You got to be willing to do your homework. You know, I joke with someone seriously that there's a lot of bankers out there that are pretty lazy. They don't want to do all their homework and really understand how this industry is going to respond. I'm pretty far along from a regulatory environment. You know, I sleep well at night understanding the regulatory environment. There will be changes, but we're on top of that, and we'll lead the change. We should be following it. It's more towards traditional industry build-out and, you know, all the other factors that it's a commodity at many times. So you look at price volatility, what's your break-even point, all those types of things that would go into a manufacturing distribution business.
And we heard earlier some discussion about what's happening with pricing compression. What is the approach when you're looking now at companies? How are you viewing this trend on the pricing side, particularly on the wholesale?
Yeah, so I can take that. We've really noticed a big uptick in people that control their own retail and can control shelf space. And so in this environment, we're seeing this kind of compression on the wholesale market. We value that highly because it is a good way to keep your margins. We view these, and you see it in every state, and I mean, every single one. They come online, there's not enough product. Everybody races to build out the infrastructure to produce the product. Prices skyrocket, then the supply is met, or the demand is met, and then typically oversupplied, prices compress. There are some winners and losers, but generally what we view it as is, you know, volatility on short term, on a longer term upward trend. I mean, today it's a $25 billion a year annual sales. It's bigger than Major League Baseball and the NFL combined. It's expected to go to about $45 billion in sales over the next 5 years. This is a real industry, and, you know, I agree with Jem. I do think we are going into a recessionary environment, but there's some pros and cons being in cannabis. Having that kind of growth tailwind behind an industry should help soften some of the blow that you might see in a recession environment. On the flip side, there's 280E still and a lot of regulatory issues that have just slowed everything down. So, you know, our general view is politicians are going to act in their own best interest, and, you know, once these industries pay enough tax dollars, which they are. For instance, in California, $500 million last year in tax revenue was collected. You're not going to let the legal business go out of business. There, you know, and you see that with Newsom repealing the cultivation tax. You see it with him addressing some of the other things. It hasn't gone as far as we'd like to see it yet, but we think that it's ultimately going to be addressed, and the industry will be a very viable industry.
And how have the types of products that you've been offering been changing in light of this recessionary environment?
So, I mean, I would say there's a couple of things on how we adjust our underwriting. It can be a little bit more conservative, but we're also seeing a kind of up in quality bias as well, to where, you know, because this industry is starved for capital, we're seeing the same thing. Our investor base was primarily a retail investor base that we've built up to this point. But we're starting to see a shift where we are getting institutional level capital providers either coming in to our funds as LPs or seriously taking a look. So we think that will be an interesting kind of leg up. But kind of combined to that, we're able to really, because we have access to capital today, really able to pick and choose who we want to give that capital to. So it's a combination of up in quality and just being a little bit more conservative on states and markets.
Yeah, just to echo that, I think from our standpoint, our first fund was much more seed, Series A, and then we started, right now we're very much shifted away from that more towards kind of Series B, but really, not necessarily backing just pure startups, but much more focused on companies that have demonstrated some commercial traction, and now it's about really kind of accelerating that traction.
Right. It's interesting when talking about the startup versus finding cash flow in companies, because now there are more and more coming along, which I think is great for the industry in general. On that, we all heard about President Biden's announcement a couple of weeks ago that he would be pardoning all simple marijuana convictions and ordering his administration to look at how marijuana is currently scheduled under federal law. Are you seeing that as an olive branch, or is this going to be bringing about meaningful change to the industry and, for purposes of this panel, to the capital markets? Jim, if you want to.
Well, I think this also goes back to the last comments that were just made on regulation and government. So first, let me start with I'm concerned and disappointed with federal, state, and local authorities not actively policing the black market, primarily because of the health and safety of the American consumer.
Yeah.
This is clearly a product that people are inhaling and ingesting. And for those of us who are in the industry, we know how regulated markets work and the amount of intensity that goes into the health and safety of the product. And so I just can't imagine that some black market grower in California sees mold on his product and decides to burn it and throw it in the garbage, as opposed to put it into the system where people are consuming it. And you know, when we hear about California collecting $500 million of taxes, it's de minimis compared to what the black market is doing. And the black market isn't just a bunch of bandits. It's, in my opinion, it's large organized crime, cartels, and this is big crime business that's into cannabis right now. And until federal government and state government start taking that seriously, the industry is going to have some serious stress. And it really bothers me that they don't. In terms of Biden's, and I served in office for 12 years, so I have a healthy disdain for government from seeing it from making sausage. And listen, I think government can be great, and I'm not putting down government. I'm just saying that we're falling short here as a country in policing this product. In terms of Biden's comments, and again, I'm not going to be political, so don't try to paint these comments into blue or red camp. I would just say that certain presidents will get up on the podium and speak their mind, and maybe their staff wasn't prepared what they were going to talk about or say, and it would involve major policy changes. I don't think the Biden administration falls into that camp. I think if Biden gets up and makes a declaration as he did, there was some larger strategy that the White House has, and most likely the Democratic Party. I can't imagine that was done in a vacuum, especially from Biden, who's not known as a pro-cannabis candidate or politician, or president. So I would imagine that, as I said earlier, that based on the Biden announcement, that we will see attempt towards federal changes to existing laws. How deep that stroke of the pen goes, I don't know. But as others have said, I think it's going to be more incremental. I don't think we're going to see decriminalization, the elimination of 280E, companies listing that touch the leaf on the NASDAQ tomorrow. But I do think that we'll see some sensible reform that will help banks like Joe perform their function so that you can manage cash in a more efficient way, so we're shining the light on it. And one of the things that always astounded me, good that the federal government did, was the SEC has been regulating these companies for a long time. And they made a decision early on that said, rather than have these companies become billion-dollar companies that are off the books and we're not controlling, and I am the chairman of the Canadian branch of AGP, so I'm licensed in Canada and I'm licensed in the United States. I have 20,000 disclaimers. Every time I say something, I have to put a disclaimer. And I'm not saying anything wrong about the Canadian banking institution. I would just say that the regulatory regime in Canada in the capital markets is very different than the United States. And so with the SEC saying, we're gonna take these companies and we're gonna let them file registration statements, and we're gonna let them file current statements, and we're gonna do our analysis and let FINRA do their work and the regulatory agencies do their work, I think that was wise, and I think that's what we should be doing up and down the line in the government in the United States. And if anybody really cares about this industry, I think one of the best things to do is voice your concern to your local candidates and say, cannabis is here to stay. We think it should be regulated properly. We should keep the black market out, and we shouldn't penalize companies with 280E taxes and other fees who are doing it the right way.
Right.
I would just touch on that. I agree. The enforcement of the illicit market is critical. That and 280E are the two biggest issues facing the industry. and it's kind of frustrating from somebody, and I share Jim's frustration, is that the states went so far to do background checks and make everybody jump through these hoops to keep organized crime and other things out of a legal market, but have basically largely let a parallel industry, certain states worse than others, exist that is absolutely that. And there's kind of this political view right now that says, you know, a lot of people were wrongly imprisoned for cannabis and now it's legal, and so there's a hesitance to even enforce today. But what it is you've actually created a situation you're hoping to avoid, and it's hurting your legal industry and hurting the safety and efficacy of these products and for your consumers. And so we would definitely love to see a step up in enforcement.
And I think that's where the compliance issues bar is going to get higher, not lower. Because if you look at the impact of illicit activities based on, you know, the anti-money laundering, BSA, even the state losing revenue, the revenue leakage state by state, I think a lot of focus is going to be on understanding seed to sale. I mean, I was discussed with regulators, if you're going to launder money, it's a pretty good industry, right? So you want to make sure all these controls are in place and whatnot to make sure you know your customer effectively, so that even when you get the reconciliation between the federal and state government from a legality standpoint, there's going to be a very high compliance bar, just given the nature of the business, no different than alcohol was for tobacco many years ago.
Right. And I think one of the biggest pieces is a question of uplisting and whether that is a realistic possibility. There's discussion about safe banking. Are investors, is there any expectation of this happening in the near term from the investors you talk to, or is it all uncertain and we hope for change if and when?
So we try not to raise money based on hopeful legislative changes. So the capital we're raising is not dependent on that.
Yeah.
And we need to be able to deploy capital in an environment where that doesn't exist, which is what we're doing successfully now. I mean, it depends on who you speak to. You know, there's more chatter today that SAFE may pass in the lame duck session than I think I've ever heard. Will it pass? I'm not sure. I think the Biden announcement, as was mentioned on earlier panels, it had not a lot of real practical effect, but I thought what it had was an effect that there's real federal action that was taken under, even though it affected such a small population. I think SAFE would be similar, and the question is, what is in SAFE? The version I've heard being talked about do not include the uplisting ability and other things. It's more about addressing credit cards being taken and maybe expanding the banking relationships. But I do think while that may not change the day-to-day too much, maybe it has more of an effect that you know, investors and other things feel more comfortable entering the space because it's just one step closer to some federal backing and support of the industry.
Yeah, and I would agree with Travis on that. I don't see, at least from all of our conversations, I don't see any kind of uplisting to U.S. exchanges incorporated into this latest bill. As to TSX, I think is a big question mark, and Jim, welcome your thoughts on that. But in terms of, you know, we have to have our companies be able to grow irrespective of what happens, you know, at the federal level.
Right.
And I think that the same thing from a new investor standpoint, if SAFE passes, it does give, you know, I would say stamp of approval or some more credibility to the industry. So I do think that there's going to be some additional institutional capital that are open to take more risk to come into the space. I don't see, you know, long-only mutual funds coming in, but I do see hedge funds and I do see some other financing sources kind of coming in to the space if that, you know, if ultimately that passes.
Yeah, I agree. I agree with that wholeheartedly. And on your comment about the TSX, I mean, what we've heard is that the TSX is going to be much more likely to allow the companies to list than the U.S. national exchanges if SAFE passes. So if SAFE passes, maybe the TSX, we don't think NASDAQ or NYSE. And as you said, the more important point than uplisting is investors, right? Because we have a lot of companies that are listed on the national exchanges that are ancillary companies that are selling at ridiculously low prices. So the NASDAQ listing hasn't been able to defend their valuations. And the hope is that, as was just said, that we're going to see more family offices, and there's more money in family offices than hedge funds. I mean, there's a tremendous amount of capital coming out of family offices, and these family offices aren't, $10 million family offices, or it's billions and billions of dollars, and hedge funds. So I think the hope is that there will be incremental change that will facilitate more new dollars being invested into the sector, which will help fuel the growth and will enhance the value of these companies.
Right, as opposed to a binary, if one thing happens, then all the capital comes in. The hope is that there's going to be an ongoing influx of capital, right? Yeah. And on the structuring side, just to step back, one of the common structures that we saw over the last 18 months was the SPAC, and it seems like that has all but gone. Could you talk a little bit about, if we think that there's any viability to return?
Well, I hope so. That was my meeting before this one.
Yeah.
So,
As I mentioned, we actually raised the SPAC in the beginning of 21, $200 million on the NASDAQ. It was a JP Morgan-led deal. Actually, the only thing JP Morgan ever did cannabis-related. And then we bought a technology company in cannabis that we closed on in June. Look, I mean, obviously, right now it's a very difficult time for SPACs in general, and I think a lot of them, basically are starting to return capital to investors. But the SPAC product has been around a long time, and I think that it will continue to be around, just because I do think it has a place, because it is a way to facilitate raising capital, and it's a way to facilitate a company, going public. It's not the be-all that ends all. But I think that we just have to kind of let this, this play out a little bit, just because there's, way too much capital has been raised through SPAC vehicles. It's very difficult to convince a company right now to go the SPAC route. It's challenging. But I do think that that's going to be something that's kind of temporary, and eventually the product will evolve. Some of the issues that the SPAC product has today will evolve, both from a structuring standpoint and also from an SEC standpoint, because the SEC is not thrilled with the way the current SPAC market's been evolving.
Right. Now, Jim, I wasn't sure if you had any thoughts on that as well.
Yeah, I agree. I mean, the SPACs were out of favor, then really in favor, and then out of favor, and clearly the current leadership at the SEC is shining a bright light on it. We're going to see some more regulatory reform, but there is an appropriate place. It's not, direct listing or doing an IPO. These are all different avenues for companies to take. Some are appropriate, some are inappropriate, and I just think it's, like for us in the business, it's important to advise customers or clients in the right direction. Sometimes I have calls or meetings with businesses, and they say that they'd like to go public through a SPAC, and I'll say it's really not appropriate for you. And then other companies will tell me, I want to go do an IPO, and I would say you're more appropriate for a SPAC. So, yeah, I don't think SPACs are going to go away, and I think that there'll be some modifications in the regulatory regime, but I think they're here to stay.
And I just did want to, we have a few minutes left. Joe, I wanted to jump back to you on the commercial side. We've been talking about federal legislation, and how does this potentially changing environment affect you on the commercial side in the way that your bank operates, and then in the way that you're actually pricing and structuring these deals?
Yeah, it's a much more expensive industry to do it right. It's you got to make the investment, and as you know, banks are responsible for the compliance risk, whether you outsource, have vendors, or everything else. So you want to make sure you have the right partnerships to manage it efficiently and to grow and scale it. Because I do think it's best to be a national business than just isolated to one state, just given the ultimate consolidation. It's a little bit challenging because every state has their own regulations that are also evolving, just given the newness of the business for each individual state. And we're looking sort of one step down the road, as once it becomes more mainstream, what happens with intrastate commerce. I mean, because you are dealing with something that is somewhat of a commodity, lots of investment in cultivation facilities, and without that control of supply and demand, the industries can get upside down pretty quickly. We've seen that in different states, just given the volatility of pricing. So we're kind of looking at it's just not a regulatory risk per se, but how it's going to evolve. And I think we're beyond the reputation on whether it's a gateway drug and all this other stuff. I think that's all in the rearview mirror. I think that my discussion with regulators have been it's how it gets deregulated in one hand, but then re-regulated as a compliant activity in the other hand. Because with the once you get the reconciliation between state and federal, there will be new regulators. I mean, for instance, the Federal Reserve doesn't really regulate it per se because they don't allow it technically. So once they do have the mandate, they'll shift from a FinCEN approach more to an agency approach. And that's where I think that you want to be prepared for that. And I think going at it with adequate resources and be ahead of the curve is going to pay dividends long term.
Right. Well, thank you guys. Before I turn it over to the audience to see if there were any other questions, anything else, any other trends or thoughts that you guys had before we turn it over?
I just think a lot of this capital going in makes it a lot easier for banks to get in. Give someone a little cushion there.
Right. Well, are there any questions from the audience as well? Yeah.
Thank you for sharing all your perspectives with us. You all commented on how we're sort of going into the recessionary environment right now. It's really the first time that cannabis industry is entering a recession. Legal cannabis has been around. If we look to sort of other industries and how they behave in a recession, do you think that cannabis will ultimately come out as being more recession-proof, like alcohol, beer, and wine is, or do you think it will eventually be more damaging to us?
Yeah, I can take that. I think I do think you'll see elements like you see in alcohol where it makes people feel good. They are going to probably still use it. I mean, I would say cannabis has kind of gone through a little mini recession, which was COVID, and it actually significantly outperformed. And the dynamics there are different than your typical recession. So we'll wait and see what happens if we are going into it and how that'll play out. I think one of the risks to the space, and it gets back to the thriving illicit market in some of these states, is that typically in a recession, consumption will go up in alcohol, but price point typically goes down. And so alcohol, there's not an illicit market to down trade to. And so there's a risk that some of these consumers down trade to the illegal market. And so again, whatever these states can do to continue to put that out and help this industry, help this industry out would be beneficial.
Yeah, I would agree with Travis as well. We actually went back and took a look at the data through 2008, 2009, through the alcohol industry, and just to see how that worked. And yes, there is a little bit of a dip, but for the most part, people will continue to consume. But there does a mix shift that does take place. So it shifts from call it the premium products more towards value-oriented products. While obviously, what people are going through that, and I think in cannabis, to Travis's point, there is a risk that people, to save money, will shift into the black market. I mean, hopefully not, but that's the risk here.
I have a question around eventual descheduling, and I didn't hear anyone talk about research and how that will impact you and financial sources, and how much you'll focus around research, which is sorely needed within the cannabis industry. So who wants to take that?
Yes, totally agree. Research is needed, and research is actually being done. We have a company in Connecticut, actually, that we just sold to Verano, but there's a research element with Yale where they're doing research with Yale specifically around specific applications of cannabis. And the other universities, I know UCSF, UCLA, University of Hawaii, University of Mississippi, they're all kind of doing research. And I think, just to go back to Biden's announcement, the announcement around we should really take a look at rescheduling cannabis. In order to do that, the FDA and all the other agencies are going to have to be comfortable from a research standpoint. So I do anticipate actually research accelerating over the next 12 to 24 months in the space.
So we agree with that, and a lot of people don't really know is the DEA just issued more licenses, so the DEA actually has a license to do it. We funded one of the first facilities in California with a DEA license, so they're actually held to a higher standard of quality control when producing it. They're allowed to ship over state lines for research purposes, specifically to universities and other things. So yes, that's an issue that needs to accelerate. We're helping that accelerate where we see opportunity, and yeah, we expect to continue.